Good morning, and thank you for joining the Saskatchewan Retirees Association webcast. My name is Harold Hugg, and I'm president of SRA. And on behalf of the SRA Board of Directors, we are really happy to see the interest in members in this important new initiative, the introduction of PEP's lifetime pensions. I see we have 188 people that registered for the session today, and that shows a tremendous interest in this initiative. I want to first take a moment to acknowledge that the land where this webcast originates is Treaty 4 territory, traditional territory of the Indigenous people and the homeland of the Métis. This is an exciting year for SRA as we celebrate truly a momentous occasion, our 50th anniversary. This is an incredible milestone for SRA and a testament to the dedication and passion of our members and volunteers who over the years have worked tirelessly to support retirees across Saskatchewan. Your board has established a 50th anniversary committee tasked with creating opportunities for you, our members, to engage and participate in the festivities. From special events to commemorative activities, we are planning a year-long celebration that will honor our past, celebrate our present, and inspire our future. Your board, stay tuned because you'll be hearing a whole lot more about our 50th anniversary celebrations as we go forward. SRA's mandate is to provide services and support to meet the needs of retiring provincial public sector employees. Now, with well over 4,000 members, we continue to strive towards fulfilling our mandate. We do this with the support of over 90 approved organizational members, and our focus is to continue to attract new retirees and grow and strengthen the association. The webcast today is a continuation of a series of information sessions that SRA has initiated that reflects our commitment to engage and inform members on topics of interest. At the end of the session, you will be also asked for your thoughts and ideas on topics of interest and future webinars. Again, we are pleased to be able to bring this webcast to you today to inform and respond to your questions. Now I want to provide a bit of information on the webinar itself. At any time, you can ask a question or create a comment by using the Ask Question box in the right of your screen. We will be identifying the members asking the questions by their names, which will help us to do follow-up if more detail is required. Similar questions will be grouped together so that we can get to as many questions as possible at our session here this morning. Following the session, this webcast will be uploaded to YouTube and will be available for viewing on the SRA website. I now want to introduce Lyle Fluter, who will be assisting us today with handling the questions and helping us move through the agenda. Welcome, Lyle. If you have any technical difficulties during the webcast, please click the tech support button on the top right of your screen, and VoiceWorks will try and resolve any issues that you might have. I would now like to introduce John Mowbray, co-chair of Pension and Issues Committee, who will introduce our guest speakers today. Take it away, John.
Thanks, Harold. First, I would like to provide some background about the Saskatchewan Retirees Association's interest in today's topic. SRA became aware in 2018 that some major pension stakeholders were lobbying to change Canada's Income Tax Act to allow for the development of some new retirement options for people with defined contribution pension plans like PEPP. We at the SRA thought that the new options could benefit our members. So after the act was changed in 2019, we wrote to the Provincial Minister of Finance about them. The minister replied at that time that these new options and their potential to benefit PEPP members was being assessed. We continued to follow the issue through our discussions with Plannera, or PEPP at that time, and we were excited when the PEPP board decided to offer the new lifetime pension option. So, we're pleased today to host a webinar on this topic. Now I would like to introduce and welcome three people from Plannera who are with us today. Rejoice Orduagara is here to present the lifetime pension option to you. Rejoice is a retirement information consultant at Plannera. She provides personalized advice and financial solutions to people or to PEPP members. He specializes in retirement planning, investment strategies, and wealth management. Rejoice has a degree in economics, a chartered financial planner designation, and several professional certifications. She's committed to empowering her clients with financial knowledge. We also have Kingsley Egbeta and Nick Saparia, who are here to answer whatever questions you might have about the lifetime pension. Kingsley has 24 years of experience in the financial sector. He has a certified financial planner designation and several other qualifications. He provides retirement planning services, financial education, and member consultations at Plannera. Kingsley is known for his ability to simplify complex financial concepts and for his commitment to helping individuals to achieve their financial goals. Nick joined Plannera as a retirement information consultant in 2024 and helps pension plan members with their retirement planning. Nick has a personal financial planner designation. His financial experience includes positions as a financial advisor, as a manager, and as a financial planner in the private sector. So with that, I will turn things over to Rejoice for the presentation. Welcome, Rejoice.
Thank you so much. And hello, everyone. Welcome to the Lifetime Pension presentation. My name again is Rejoice Odoegara, and I am one of the retirement information consultants, and I will be your presenter for this webinar. We're all excited about the upcoming Lifetime Pension that will be launched this April, and I hope you are excited as much as we are. Before we get started, I'm going to go over some few housekeeping. I would not be parsing throughout the presentation to answer questions. However, you're welcome to drop your questions as this will all be piled up and will be answered within the time frame allotted for this webinar. The questions will be reviewed and answered by my colleague, Kingsley and Nick, who are also on this call as they've been already introduced at the end of the presentation. So essentially, I get to the easy part of the job today. Now, in addition to the answers that will be provided, there will be also a lot of information on the PEPP website about the lifetime pension, and you can refer to those, and you'll be given also many opportunities and point of contact to get in touch with us in future. Now, to give you an idea of what the workshop aimed to achieve today, this session will cover the essentials of the lifetime pension, how it works, and why it may be a valuable or an add-on to your retirement option as a defined contribution plan member. So ideally, the lifetime pension is designed to, complement the variable pension benefit, and we will show you how this different piece can fit together to create the retirement plan that you hope for. It is aimed to provide members a chance for a long-term financial security with a dependable income for life. Now, the lifetime pension is new, as we all know, and to simplify it for better understanding, we've prepared a short video that will be played shortly, highlighting the key aspects. The video would provide a general understanding, and then we will go over the rest of the presentation and review the key features, provide a comprehensive overview of how the plan works. All right, so let's get started with the video.
Introducing our new lifetime pension. Retiring or retired members can now move some of their PEPP money into our lifetime pension. It's designed specifically for those who'd like to receive a monthly retirement income for life. So, how does it work? Your money goes into a pool with other lifetime pension members, and these funds are invested in PEPP's Moderate Fund. The lifetime pension has an annual rate of return goal of 4%, also known as a hurdle rate. However, the Moderate Fund's annualized rate of return is typically higher than 4%. For example, if the Moderate Fund's rate of return for the year is 5%, your lifetime pension payment for the next year will increase by 1%. The following factors may help you decide if our lifetime pension could be an essential part of your retirement plan and a better fit for you than traditional income options, including annuities offered by insurance companies. Payments are influenced by market performance. Your payments may be adjusted up or down from year to year depending on the fund's performance compared to the 4% rate of return goal. But in the long term, we expect payments to increase, helping you mitigate risks in retirement. There are no commissions when you buy. You continue to benefit from PEPP's lower fees and professional investment management. You share risk with others in the fund. You'll receive monthly pension payments from a pooled amount. Given that some people live longer than others, the pooled money can be invested with a longer risk horizon, meaning a dependable monthly income for everyone for the rest of their lives. You may have heard about longevity risk. We're living longer than ever, which increases the risk we might outlive our retirement savings. Planning for this possibility is an important step in having a more financially secure retirement. Our lifetime pension can help reduce longevity risk by providing you with a dependable monthly income for as long as you live. And should you pass away, you have options for your spouse to continue to receive payments for the rest of their life, or for your beneficiaries to receive payments until the end of a chosen guarantee period. PEPP's retirement information consultants are here to help you understand the lifetime pension, how it can be combined with our other retirement options, and whether it's a good fit for you. Visit us online to learn more and to view a full list of upcoming webinars on the PEPP website.
All right. Now you have an idea what the lifetime pension is and how it is supposed to work. So let's dive into more details here. So what is a lifetime pension? The lifetime pension is another option for your retirement income source. It is designed to work together with the variable pension benefits, combining the best of both worlds. So while you don't have to use both options together, the product is designed to complement the variable pension benefit, providing you with a dependable income now and in future, so you don't have to outlive your money. We won't spend time on the variable pension today, as some of you already are familiar with it. Now, for those of you who might need a refresher, it is one of our retirement income options. Now, according to stats, Canadians are living longer than ever, and stats shows that people retiring at age 65 have an average life expectancy of 85 years. And 50% of those will live beyond age 85, which begs the question, will you have enough money to last you your lifetime? And the goal of the lifetime pension is to ensure that you have income throughout your retirement, even as your need changes over time. For example, most members would say they want money upfront during their active early phase of retirement years. However, as life slows down later, you might not travel as much, but you still want to know that you have funds coming in, and the lifetime pension is designed with this in mind. So by offering stability, this product fits into your overall retirement strategies, providing you financial security. It gives members of defined benefit contribution an additional option to achieve their retirement goals. So with a lifetime pension, you can enjoy the early phase of retirement and still have peace of mind for the later years. So this product aims to create a well-rounded retirement plan, ensuring that you don't outlive your savings while offering flexibility when you need it the most. So basically, it offers that added security by providing dependable income throughout retirement, and it provides longevity protection, meaning that you cannot outlive your pension payments. Now, how does the lifetime pension work? This pension plan is designed to provide a steady monthly income to members. Now, the risk of outliving your savings is shared among everyone in the plan, as your asset will be all put with those of other members in the lifetime pension. And the funds will be invested in the moderate fund. So this means the return received in this fund will be the same as those you would get if you were currently an active member and you are invested in the moderate funds. So maybe you're in the variable pension benefit right now and you're invested in the moderate funds. Those investments are exactly the same, and so the returns are going to be the same as well. Now, by pooling the risk among all members, the lifetime pension has the potential for a higher return. Additionally, the payment you will receive will be reassessed and adjusted annually based on the performance of the moderate fund. So this means the payment isn't going to be fixed for life, unlike the traditional life annuity. Payment can go up or down based on two factors, such as the return from the moderate fund and the overall longevity within the plan. Now, it is aimed to give members, again, a dependable income stream while adjusting to changes in the investment return and members' longevity in the pool as well. Now, this approach will help ensure that you would have the financial security throughout your retirement years and that you don't outlive your saving. So one of the questions would be, who can sign up for the lifetime pension? Well, members need to be at least 50 years old or younger than 95 to join the lifetime pension. Because once you've reached 90, the product might not hold as much value. So therefore, you must be under 95 to sign up. This ensures that the pension remains beneficial and valuable for your financial planning and retirement need. Now, the initial deposit to put into the plan in 2025 would be $14,260, representing 20% of the year's maximum pensionable earning. Now, having said that, keep in mind that $14,000 into the lifetime pension, it's not going to give you a very large monthly payment there. So it's just the required minimum. Now, on the high side, you can contribute up to $1 million to the lifetime pension. So you would have a range of minimum of $14,260 to a maximum of $1 million for contribution. Now, this range ensures that you have some flexibility in how much you want to put into the plan, aiming for a long-term financial stability. This approach helps you plan better for your retirement, giving you options that suits your financial situation. Now, any funds invested in the lifetime pension must be locked under the Saskatchewan legislation. So this means any funds already in your PEPP account would qualify. If you were working in Saskatchewan and you had a previous pension, that would also qualify. If you previously made additional RSP contribution into your PEPP account, or you have the variable pension benefit, those funds can also be eligible for the lifetime pension. Now, you can choose to put all or part of your pot of money into the lifetime pension and use it alongside with the variable pension benefits. The choice is totally up to you. So, for example, let's say you have 500,000, you can split those and say 200 into the lifetime pension and then 300 into your variable pension benefit. However, these funds must be under the Saskatchewan legislation or in the PEPP variable account already. So let's say you had worked with an employer outside Saskatchewan and accumulated some pension. Now, because those are not under Saskatchewan legislation, they would not qualify. So they have to be under the Saskatchewan legislation to qualify for the lifetime pension. Regarding the investment performance, the lifetime pension is linked to the moderate fund. Now, an actuary will perform an annual review of the lifetime pension as already established, and this review would, it's important because it's going to this review will assess the investment performance of the moderate fund over the last year. And based on this assessment, payment will be adjusted annually to reflect the difference between the actual yearly investment return of the moderate fund and the hurdle rate, which is set at 4%. Now, if the moderate fund return exceeds this hurdle rate, your payment will increase accordingly. In the next slide, I will go over how this hurdle rate ties to your payment. Now, beyond the fund performance, the review would also factor in mortality rates of members in the plan. This means that the actuary will consider the longevity experience of members when making this adjustment. So if members are living longer than expected, the payment may be adjusted to ensure that the fund remains sustainable. And if members do not live as long as expected, the payment would also be adjusted to reflect the reduced longevity risk. So overall, the longevity risks have a minimal impact on the payment that you're going to get as compared to the fund performance. Now, what is the hurdle rate? In the lifetime pension, we do have the term called the hurdle rate, and this hurdle rate for the lifetime pension is set at 4%. So basically, this is the rate that we believe that we can achieve, and it's used as a baseline for your payments, starting in the initial year and afterward. So it represents the goal of what the moderate fund would achieve. And once we've gone through the full year, the payment in June could be adjusted upward or downward based on the performance of the fund. So if the moderate fund return exceed 4% hurdle rates, the payment will increase. And if the return falls below this rate, so would the payment decrease as well. Now, this ensures that the pension payment remain aligned with the fund performance, providing a dynamic approach to managing your retirement income. So for example, say in 2024, the moderate fund returned 8.8% in the fiscal year ending in March, with the hurdle rate set at 4%. So this means the payment for the following year, which would be 2025, would increase by 4.8%. If, however, the fund had a negative return of 3% in 2024, the payment would decrease by 7% for the next year. So this adjustment is based on the difference between the actual return and the hurdle rate. So it's important to know that this adjustment do not affect the amount of money in the plan, but rather the payments that you will receive. So each year, the payment will be reviewed based on the hurdle rates, the actual performance of the moderate fund, and the potential longevity adjustment. Now, this session looks back at the return of the moderate fund from 2018 to 2024. Now, these are historical return, which means there's no guarantee that the return will be the same in the future, but we can look at the past trend and see what it's done so far. So you can see that since 2018, the moderate fund has generally had a positive return, except in 2022 when it had that negative return of 8.4%. So again, those are historical rates of return, absolutely no guarantee that this would be the returns going forward. But they give us a sense of how the fund has performed over time. So looking at this trend, you could see that the moderate fund on average has been performing over that 4% hurdle rate. Now, looking at this history helps us understand how the fund has performed and helps with future planning as well. We've used these numbers for modeling to show you some examples. This can give you an idea of what to expect, even though the exact future returns cannot be guaranteed. Now, one thing to keep in mind, looking at this trend, is that there will always be those drops and rise in the market, but the average at which the market is up is more compared to when it's down. And for that reason, we believe that it is more likely going to, keep up with inflation. Now, when we look at the way the moderate fund is invested, the moderate fund is invested in a mix of assets. About 45% of the funds are invested in income sources like bonds. Another 27.5% is invested in equity, which means the stock market, including global market, not just the Canadian markets alone. And the remaining 27.5% is invested in alternatives, such as real estate, farmland, infrastructures, now, which helps diversify the fund. I see this as, having your eggs in different baskets, because that diversification within the fund help offset some of the swing that you might see from only holding a single type of investment like stocks or just bonds. So this approach helps ensure that the funds remain balanced by spreading the investment risk across different type of asset class. Okay, this is an example of how the payment schedule might change or what it might look like by backtesting it to 2019. For illustration purpose, based on a 100,000 initial investment starting, say, 2019, and assuming that your initial payment is based on a 4% hurdle rate, here's how the payment would look like. In 2019, if the fund had returned 5.3%, have it in mind that the hurdle rate has already been calculated in there. So this means your payment for 2022 would increase or would have increased by 1.3. Now, the following year, the fund returned 6%. So the payment increased by 2% again over the hurdle rates. And in 2021, the rate of return was 10.7. So the payment was adjusted upward again by 6.7%. However, in 2022, there was a negative return of 8.4. So this means the payment will be adjusted by minus 12.4% in 2023, accounting for the negative return in itself and the hurdle rates. So this is just to give you an example of what that payment would have potentially looked like if you had been on this plan from 2019 to 2023, given the rates of return within those years. So it's important to keep in mind that just as the yearly investment returns are not guaranteed, this payment are also not guaranteed. They are set for the first period and then adjust annually in June based on the fund performance. In other words, you would notice that payment change in June. So again, just try to give you a sense of how those payments would be adjusted over time. It's important to recognize that everyone learns and processes information differently. So here's another slide showing that based on the previous performance of the moderate fund, what the payment would have looked like. So now this projection illustrated on this graph are based solely on the past performance of the moderate fund and does not factor in the mortality factor. So each year, there might be a small adjustment due to mortality rates. The actuaries will review the plan annually, considering factors such as the longevity of the participant, the members. If more members live longer than expected or pass away earlier than anticipated, a small adjustment may be made. However, this adjustment are typically minimal compared to the fund performance. So again, looking at this chart, you would see how the payment has adjusted over time. In the long run, there will be those few bumps, but overall, the payment is more likely to trend upwards on average. And looking at this graph again, there is great potential that the payment you started with, you might probably not get to that again. So looking at the first year, there is $520, and it never went back to that, even though there was a drop in the 5th and the 9th year. So basically, it helps keep you afloat with inflation. Very important. So this slide illustrates how the lifetime pension product works and when that payment will be adjusted. So starting this month, we are accepting applications with the first payment starting at the end of April. Now, for those that send in their application, this payment will start in April. Now, what will happen is you will continue to receive those payments until May of 2026. Now, by March 31st, we would know what the performance of the moderate fund had been for the previous year. And so the actuaries will be taking that information. They will be looking at, again, the mortality factor inside the fund. And by the beginning of June, those members that did join we will be sending out information to tell you how your payment will be adjusted at the end of June of 2026. So the payment, once it has been set at the end of June, will continue for the entire year. And again, in March of the following year, we would know the performance. The actuaries will take some time again to do their calculations, and your payment would adjust again the following June. So the goal is to get the ball rolling by the end of this month, as already mentioned. However, if you're not able to join in April, the program will be offered throughout the year. But we will be notifying you in June if there is any adjustment, whether your payment is going to go up or down. And that will set the cost for the following year. Okay, so this might be a reminder for VPB members. When you start drawing from your pension, we would usually withhold taxes using the payroll tax system, same way as employer would withhold taxes. This is different from what your financial institution does when you take your money from an RSP or a RAIF account. So financial institution withhold taxes differently. With PEPP, we use the payroll tax system. So part of the paperwork we would require you to do is filling out the TD1 form. By filling out this form, you can claim any assumptions that applies to you. And PEPP, we use this form to determine how much taxes to withhold from each payment. So as mentioned, we would withhold taxes using the payroll tax system, and this often raises questions. Now, well, the retirement information consultant are available to help you understand what your net payment would look like and how to fill out these forms. It is essentially important if you use this lifetime pension alongside with another pension plan like the variable pension benefit or another plan that you may have. Lifetime pension is eligible for pension income splitting. Now, income from the variable pension benefit or PREV is not eligible for pension income splitting until a member is age 65. While income from a life annuity, a defined benefit plan, or the lifetime pension is qualified for income splitting at any age. So essentially what happened is when you receive a benefit from your pension, that income is taxable to you. But you could, as long as it qualifies as eligible pension income, split that between you and your spouse. And there are definitely reasons why you may want to use income splitting if you want to be tax efficient as a household. So here's an example of how this might work. So let's say we have Jack and Jill. Jack receives $60,000 a year from his pension income, which could be a combination from the variable pension benefit, the lifetime pension, or a RIF. Now, if Jack paid taxes on his $60,000 income, it could amount to about $7,962 in taxes, almost $8,000. And there might be various deductions available, but roughly Jack would owe around $8,000 in taxes on his pension income. Now, if Jack could split his income with Jill, who has no income of her own, he could reduce their overall tax bill. And the most Jack can split is 50% of his income. So if they both claim $30,000 instead of Jack claiming the full $60,000, their combined tax bill will be closer to $5,000. And this would save the household almost $3,000 in taxes. So I hope this example helped clarify how income splitting works and how your household can be more tax efficient. Keep in mind that the money is not changing hands here. It's just paperwork that needs to be done. So while signing up for the lifetime pension, you have the option of choosing either a single or a joint pension. So if you're single, you would likely opt for the single pension. And if you have a spouse, you can choose a joint pension to ensure funds continue to be received by your spouse if you pass away. Now, selecting a joint pension comes with a survivor benefit, meaning that you can choose to leave your spouse 60 or 100% of your payments. Now, the higher the survivor benefit you choose, the lower your initial payment would be. And in addition to the survivor benefit, there is also a guarantee period for 5, 10, and 15 years. Now, these guarantee options ensures that your pension payments continue for a certain period, regardless of whether you pass away during that time. So by choosing the appropriate survivor benefits and guaranteed options, you can tailor the lifetime pension to best meet you and your family needs. And I will explain more about this guarantee option in the next couple of slides here. So here is an example of a single life option. As mentioned, this is designed for someone who is single or even for someone who is married but has opted for a single lifetime pension. Now, if you have a partner and you choose a single lifetime pension instead of a joint option, your spouse would have to sign a waiver form. Now, this waiver allows you to move the funds into the lifetime pension that only provides you income during your lifetime. Now, the guarantee period is not about you as the member. It's about how much your estate or beneficiary would receive if you pass away early. It is the length of time someone is guaranteed to collect your payment. So as long as you're alive, you will receive a payment for life. So example number one there, let's assume a 15 years guarantee period for a single person. If you live for 10 years and then pass away, your estate or beneficiary will continue to receive your payment for the next 5 years due to the 15 years due to the fact that you picked the 15 years guarantee period. Now, in the second example, if you live for 25 years, you will continue to get your payment, of course, for that 25 years. If you pass away after the 25 years, this is now outside of the 15 years guarantee period, no further payment to your estate or beneficiary because you have outlived your guaranteed period. Now, the guarantee period only comes into play if you pass away early. So basically, you're saying, I know I'm going to get payment for as long as I live, but if I pass away early within the next 15 years, I still want my payment to continue. I want it going to someone else. And if I live past my guarantee period, then no more payment to anyone. So as long as you live, as long as you're alive, you will continue to receive a payment for life. The guarantee period ensures that your payment continues to your estate or beneficiary if you pass away early, as already mentioned. Now, this explanation is for the single lifetime pension option. When you receive an estimate for a lifetime pension, especially if you're considering a joint pension with your spouse, you will be given a chart outlining all the different options available, and we will provide an estimate based on the hurdle rates and how the different choices, such as the guarantee period and the survivor benefit, would affect your payments. Now, keep in mind, for single option, there is the guaranteed period. For the joint life option, there are two components, the guarantee period and the survivor benefit. So example one there. So let's say you choose a 10-year guarantee period and a 60% survivor benefit. The 10-year guarantee period means someone will receive your payment for 10 years, even if you pass away. So for example, if you live for only 1 year and you receive $1,000 monthly and then pass away, your spouse, who is your designated beneficiary, will continue to receive that $1,000 a month for the next 9 years until the end of the guaranteed period. Now, once the guaranteed period falls off at the end of the 10th year, the survivor benefit kicks in, and your spouse payment will drop to 60% of your payment. So your spouse will be receiving $600 a month for the rest of their life because you had picked 60% survivor benefits. Now, in the second example, if you You picked 10 years, you lived for 25 years. Of course, you will receive payment for those 25 years. Upon your passing, the payment would immediately drop to 60%, and your spouse would receive $600 a month for their lifetime. This example illustrates the importance of understanding how the guarantee period and the survivor benefit work. Now, there's often confusion around this detail, so it is helpful to look at this number. Many people would call my team, the retirement information consultant, to walk through this scenario. And you might ask, what happens if I die? The answer depends on whether it is within or outside of the guaranteed period. The retirement information consultant can help clarify these details and ensure you understand how your choices impact your payment. You also have the option of choosing a 100% survivor benefit, but keep in mind, if you choose this, your original payment will be smaller, but the payment would not drop once it goes to your spouse. So this means your spouse will continue to receive the same amount for their lifetime. Now, deciding between these options involve considering your family needs, your spouse's financial situation, and the outcome, and the income rather that you would need to replace if you were to pass away. So those are very important conversation to have, and we encourage you to reach out to us, the retirement information consultant, if you need help understanding those options, so we can provide a personalized guidance to ensure that you're making the best decision for your retirement. Now, in the case of a marriage breakdown, up to 50% of the lifetime pension benefit can be split by a court order or an interspousal agreement under the Family Property Act. Payment to a divorced spouse or in a broken relationship would continue as long as the member is alive. Now, only the eligible spouse at the time you purchase your lifetime pension can receive the spousal benefits. When you sign up for the lifetime pension, the calculation was based on your age and your spouse's age. So if your marriage ends, the benefit will continue to go to the spouse you initially included in the plan. Even if you remarry, you cannot add your new spouse to the lifetime pension. The original spouse at the time of signing up remains survivor, gets the survivor benefit, irrespective of the situation or the outcome, if there's a change in the marital status as a result of breakdown or divorce. Now, also, someone who is single and marries after purchasing the single lifetime pension cannot switch to a joint and survival pension after the fact. Cannot add your spouse if you marry after the fact. Okay, so complementing features of lifetime pension. Now, when it comes to combining the variable pension benefit and the lifetime pension, this helps create a robust retirement strategy that leverages the strengths of both options. So when we think about using the lifetime pension and how that's going to fit into your big picture, a common notion in financial planning or when you're trying to project what your income streams are going to look like at or in retirement would be to match your fixed income with your fixed expenses. Now, in retirement, there are several essential expenses that you would still need to cover, such as your groceries, property tax, utility bills, and so on. Now, ensuring that these basic needs are met is crucial. So one strategy is to manage these expenses. One strategy on managing them is to rely on some fixed income that you may have. An example of that is your CPP, which will provide you a monthly income. It does have some indexing. It does have some indexing to inflation. So that's going to help us keep up with inflation and to pay some of those fixed expenses that you're going to have. And at age 65, you would also qualify for the old age security. Again, it's going to be another dependable income that you can count on. But what gap do you need to fill when you look at your CPP OAS / what your fixed expenses are. What gas do you need to fill that to ensure that you're able to meet those fixed expenses. And we believe that the lifetime pension might be that product that will fill that gap for you. So the fact that it is a dependable income for life, it can help you know that you're going to receive that money every month as well. So it is designed to be a complementary feature with a variable pension benefit. So with the variable pension benefit, offering you that flexibility within PEPP, in the case that you're going to have, in that case, you're going to have like a pot of money, right? And the variable pension, and you can decide how quickly you want to draw this money. You could, take out a lump sum from the variable pension benefit. You structure a monthly payment. The money will still be invested. What we sometimes hear from members is that when we first retire, we're younger and we would like to access a little more cash for traveling, and there might be other things as well that you want to do, and you need more money upfront. And maybe come age 70 or 80, you're going to slow down your lifestyle, but at the same time, you still want to make sure that you have enough money now and at the later years of retirement. And that's why we think that these two products would work perfectly to provide you that flexibility and stability that you need now and in future. So you could purchase a lifetime pension now with some of the money, and in 10 years from now, you're like, you know what, I really like this guaranteed payment, coming from the lifetime pension, and you can purchase another one. The only thing there is that it's just going to be a change in the structure, because now you're going to have two payments coming from the two lifetime pension that you purchase at different interval. Now, the benefit of doing this, of course, is that you would have that dependable income for life. Although it can fluctuate, you know that as long as you leave, you're going to be receiving that payment from there. By combining the variable pension benefit and the lifetime pension, you can create a comprehensive retirement plan that offers both flexibility and security, helping you manage your finance effectively throughout your retirement, essentially having the best of both worlds. Now, when considering your retirement option, keep in mind that for the variable pension benefit, there is the risk that you could outlive your savings if the market returns are poor for several years. In other words, market downturn could impact your income stability, as you might run out of funds, depending on how often you're drawing from it. So you might need to supplement your variable pension benefit with other personal savings like your RSPs to cover your expense. Why with the lifetime pension, it will provide you reliable or dependable monthly income for life, ensuring that you don't outlive your money. And you could strategically use this to match your fixed expense, like your CPP and OAS, as already explained. Also, the payment are linked to the market performance, offering a potential protection against inflation. Keep in mind that enrollment to the lifetime pension is permanent, and you cannot reverse it. You cannot come back and say, I want out of this. We also have the Saskatchewan Pension Annuity Fund. It is also a lifetime benefit there as well. The difference is you would know what your payment is from the start, and that payment, you continue to receive that payment for the rest of your life. So it's a flat payment. The thing is, it does not defend you against inflation. So the Saskatchewan Pension Annuity Fund, although the payment doesn't fluctuate, it could deteriorate over time just because of inflation. And enrollment to that also is permanent. So whether you're putting in funds into the lifetime pension or into the Saskatchewan Pension Annuity Fund, both of these are contracts and are established at a time, and you are not able to change your mind later. As already mentioned, you cannot request for lump sum or decide that I don't want to do this anymore. And that's why it is good to have a combination of the variable pension benefit and the lifetime pension, so you can get the best of both worlds. Now, when considering the lifetime pension, ask if it suits your need. Remember, the payment will fluctuate slightly based on the market performance. Like all PEPP funds, there's no commission when you buy into the lifetime pension, so no commission structure is built into it. Also, you're sharing the risk with others in the fund, which means you would benefit from spreading the longevity risk across the entire fund, as this can provide you with more stability and confidence in your retirement income. And those who live longer than others in the fund would continue to receive their monthly pension payment from the total pooled amount. According to stats, as already mentioned, people are living longer than before. So rather than focus on the low severity of when you think you're going to die, focus on the high severity or consequences of what happened if I live longer than I projected. Also, you will continue to benefit from the low fee and professional management that PEPP is known for. On the PEPP website, under the retirement income option, if you're familiar with our website, there is a useful tool called the Lifetime Pension Calculator. You can use this calculator to input various numbers, such as your age, your spouse's age, and get an estimate of what your first payment would look like. So this estimate is based on the hurdle rate. The calculator also allows you to explore different scenarios. For example, you can see what happens if you keep half of your money in the variable pension benefit and put the other half into the lifetime pension. Now, this flexibility let you tinker with a number and get a better idea of how your choice would impact your payment. It's very helpful to visualize your potential income and understand how the lifetime pension would work for you in combination with other options. Now, how to apply for the lifetime pension. To apply for the lifetime pension, members can request for a retirement option package and get a quote of your payment so you have an idea of what that payment would look like, after which you would need to complete the application form, which will be provided to you either offline or online. And this forms, you would make your payment selection, such as choosing between the single or the joint lifetime pension. You would also decide on the survivor benefits you want to, the survivor benefit and how much you want to leave for your beneficiary in the event that you pass away. If you are in a relationship or opt for a single lifetime pension, your spouse would need to sign the waiver document. This waiver acknowledges that the spouse will not receive survivor benefits. And completing this step ensures that you are set up for the lifetime pension that best suits your needs and circumstance. Enrollment for the lifetime pension is already ongoing for those interested. So PEPP must receive the required form at least 5 business days before the start of your payment. So if you want to start receiving your payment come end of April, we would expect to get your application in by March 24th. This will help to ensure that applications are processed timely and there won't be any delay when it comes to receiving your first payment. So if you are interested in a lifetime pension, please visit the PEPP website and complete a sign-up form. And once you have submitted your information, a PEPP representative will reach out to you to provide further assistance and answer any questions that you may have. Or you can reach out to us, the retirement information consultant, directly to help you with this process. So here's just the contact information again for my team, the retirement information consultant. You can either email us or you can also give us a call if you choose to. We also do have the pension information officer who can also be reached via email or phone number as displayed on the slide. Just a bit of direction again on who to contact for specific guidance in different areas. The retirement information consultant would be the ones that would help you read through your estimate. If you received it, certainly we're the ones that you would be speaking about your taxes and what you're likely going to net out of those payments. or maybe you want to go over the TD1 form, we will help you with that. Keep in mind that we are not accountant and we do not know what other sources of income that you have, but we can definitely help you in filling out those documents. So basically, the retirement information consultant will help you provide guidance on your entire retirement strategies, making sure that you're comfortable and confident in your decision. All right, that brings us to the end of the presentation. I will usher in Kinsley and Nick to help with the questions. Thank you, everyone.
Oh, thank you, Rejoice, for that excellent and very, very informative presentation. There's a lot of, I think, a lot of excitement around this new pension opportunity, and it really is good to see that there'll be a new option here for folks to look at with their PEPP funds. And so, right now, I think what I'd like to do is turn it over to Lal, and Lal will help with addressing. I'm sure there'll be lots of questions around this. So, Lal, I turn it over to you.
Good morning. Yeah, I have quite a few questions. I'll just start right on them. First one is from Velma. If I moved my PEPP dollar amounts out of the pension plan, can I move them back into this as I move my funds out of PEPP?
Yeah, let me take that. Sorry. Yes, you can. If you are once a PEPP member, you can always come back to PEPP. But the only thing is that if you are coming back to PEPP, you're going to be coming back into the variable pension benefit account. Then in that account, we can set up the lifetime pension for you. But one other thing I wanted to just say, I wanted to circle back to when Rejoice was making the presentation on the survival benefit. Now, the survival benefit is also going to face an annual adjustment. So it's not fixed for life. So if you're getting, for example, she had said it's $600 after your spouse dies and the 60% kicks in. Yeah, it's going to be based off the last payment of your spouse. Then annually in June, there will be adjustments. So I just wanted to kick that in so I will understand that the amount is not fixed. Thank you.
Okay. Next question is from Elsie. If both me and my spouse die, what happens to the balance remaining in the fund? Does it go to my estate or is it forfeited?
So I can take that one, Kingsley. So as Rizzo mentioned, it depends when you are dying. If you are dying within a guarantee period or outside of guarantee period. If you are dying within a guarantee period, then your estate or your beneficiary will keep receiving a payment up to the guarantee period. And if you are dying outside of guarantee period, then your payment will be freeze or forbid. Then there will be no more payment to beneficiary or estate.
Okay, thank you. Shane asked a question, can I opt out of this plan at any time?
No, you can't. It's permanent. Once you enroll, that is it. No, you can't pull out of it's a contract. So basically you can't break that contract.
Okay. Paulette had a comment. We will send that with an answer to her after this. It's not really a question. Next one's 10. Has this concept been implemented elsewhere, or are we the first? And if it is elsewhere, how are they doing with it?
So in Saskatchewan, in our province, we are the first one to implementing this one. But apart from our province, I think in the British Columbia, they already implemented this plan with the university pension. And yeah, they are doing great. And like right now, other financial institution is also planning to launch this kind of product to provide the stable income. Because as we covered in the presentation, most of the people now stressing on the longevity. People are living longer. If you think like I will run out of money in my later stage of life, this product should fit your requirement, like financial needs.
Okay, thank you. Erwin has a question on assuming you have something less than the maximum amount in your PEPP, what is the diversification of putting all your money in the lifetime pension?
I don't think I understand that question.
Okay, let me read it
But,
again.
yeah.
Assuming you have something less than the maximum amount in your PEP, what is the downside of putting all your funds in a lifetime pension?
Now, I think the retirement income option, the lifetime pension, was not designed to be a standalone option. It's actually designed to complement the variable pension benefit, having in mind that you have flexibility that comes with the variable pension benefit and a dependable, stable monthly income for the rest of your life. Like, I can quickly cite an example. I recently met with a member who has about $140,000 in his pension plan. He's 65, he's retiring in May. That's all he has. He has no other savings apart from CPP and OAS. Now, in that case, his plan originally was to put the entire $140,000 in the variable pension benefit. Sorry, in the lifetime pension. But we had a conversation and I said to him, emergencies, what happens if you need a lump sum payment? What happens to you since you don't have any other source of income apart from CPP and OAS? So he got thinking, and eventually we agreed he was going to put the $110,000 in the in the lifetime pension and keep $30,000 in the VPB. So the $30,000 he has in the VPB is flexible, is within his control. He has an emergency, he needs $10,000, he can pull it out of the VPB. Then he has a steady, dependable monthly income that is able to supplement his CPP and OS payment for the rest of his life. So again, it is not designed to be a standalone product. Do we have members who want to put all they have in it? Yes, but it's not designed, and every member's position or finances or goal is different. But I also wanted to circle back on the last question that Nick had taken. Yes, we are the first in Saskatchewan, but we are not the first in the world to be trying this out. It's been done in Australia and it's been very successful in Australia. So it's been done outside Canada and it's been successful. Reason why it might be new, but a lot of people are buying into it. Thank you.
Okay, thanks. Next question's from Dawn. CRA requires a withdrawal percentage from your pension plan each year. Does this lifetime pension plan go towards that CRA requirement?
So once you enroll into the lifetime pension, then there is no requirement to withdraw the minimum. Minimum withdrawal required for the variable pension benefit or the RIF account, retirement income fund. For lifetime pension or the annuity product, there is no minimum requirement.
Thank you. But it doesn't go towards the CRA requirement though, right?
No.
The percentage. So you would still have to take out of your other plan, correct?
Yes, from the other
The
plan,
minimum
not from the
minimum
base plan.
percentage. Okay.
Yeah.
Okay. Monique asked a question. If I had a 10-year guaranteed period and I pass away, do the payments go to my estate for the next 5 years? If I died within the first 5 years, will there be a payment sent to my estate account for 5 years?
Correct. Now, so that means you have a single lifetime pension payment. Yeah. If you die within 5 years and you have 5 years outstanding, it now depends on who your beneficiary is. If it's your estate, yes, the actuaries will calculate a lump sum payment that goes to your estate. If you have named beneficiaries, they get that payment every month for the remainder of the 5 years.
Okay. What do you explain a named beneficiary other than spouse?
Yes, other than spouse, because in this scenario, she's single. I mean, it's a single, so it could be your kids, it could be anyone else. So if you have a named person as a beneficiary, yes.
Thank you.
All right.
Cindy asked a question. Is there a cost of living on these payments?
There is no guaranteed, but our goal is to match or exceed the cost of living. As we mentioned, it's all depend on the investment return of a moderate fund and the longevity factor. So if we are looking the historical return, the fund performance will go up, but again, historical return is not guaranteed. So every year we review the performance of the moderate fund and the longevity factor, but it is not guaranteed.
Okay. Ken asked a question, what is the difference between this lifetime membership plan and the Saskatchewan Pension Annuity Fund?
Now, the Saskatchewan Annuity Fund, the SPAF, is a guaranteed monthly income for life. So if you get a quote, for example, that says you are getting $1,000 every month, you get that $1,000 every month for as long as you live. If you are 65 and you live to 140, for example, you get $1,000 every month till you die. But with a lifetime pension, it's linked to market performance. And that's what Rejoice was trying to explain when she showed you those graphs. It's linked to market performance, and there's an annual adjustment. And the whole essence behind this is to see a way of helping you keep pace with inflation and your buying powers, your consuming buying powers, but you don't have that with the SPAF. So that's basically the difference between the two of them. The lifetime pension is linked to the moderate fund performance, and annually you get an adjustment, whereas the SPAF, you know what your payment is guaranteed every month for the rest of your life.
Okay, thank you.
Yep.
Bill asked the question, why would the adjusted rate be a negative 8.4 return and it shows 12.4 rather than 4.4?
Reason, like when you are enrolling into the lifetime pension, we are already factored the 4% return. Like we are already assuming you will receive the 4% return year over year. So if there is a negative 8% return, so we need to adjust that first 4%, and then we need to adjust your return to negative 8%. That's why it does so like a 12.4%. So from first we are going 4 to 0, and from 0 to -8. So that's why it's going to be a 12.4%. When we are giving you the estimate, that 4% is already factored in your payment. Like we are assuming you will receive 4% year over year. So if you don't receive that 4%, that means that assumption didn't come true. That's why we need to adjust 4% downside plus the investment performance of negative 8%.
Okay, thank you. Just trying to get to the questions that are flying in here. If I invest $1 million into this lifetime pension plan, and then myself and my spouse pass away, can the original $1 million principal be withdrawn and included in my the estate? You can answer that question again for me.
Yeah, so no, so basically how this works is that you have $1 million and you buy into the lifetime pension. Once you do that, money has exchanged hand. You no longer have $1 million. What you now have is a form of a contract, a payment schedule, or a payment you get monthly, and that payment is adjusted annually. Now, in addition to the options you select, you have the option of selecting a guarantee period and a survival benefit. Now, if both of you were to die, for example, let's say you selected a 10 years guarantee period, and both of you were to die at the same time after 5 years, then a certain amount will go to your contingent beneficiaries because it's still within the 10 years guaranteed period. But now, if you live above the guaranteed period and the member dies, the spouse will get, depending on the option the member selected, 60 or 100% survival benefit. The spouse will get that for the rest of his or her life. So you don't have the $1 million, you just have a payment that is adjusted on an annual basis.
Okay, thank you. Neil asked the question, very good presentation. Could you provide the contact information for the consultants? It was very too small on the presentation or blurred.
Sure. For a consultant, you can call us on 306-787-3170. Again, it's a 306-787-3170. If you call and if we don't pick a call, you can leave a voicemail and we will get back to you within 24 to 48 hours. Or you can send us an email. It's a ric@plannera.ca. ric@plannera.ca.
Thank you. Cindy has a few questions here. I'll try to combine them. Can I apply anytime throughout the year? And would I do it now or wait later in my lifetime?
Now, you can apply anytime in the year. It depends on what your option is or what your goal is or what you're trying to achieve. And you can do it at any time in the year. And like Rejoice did say, you can start and say, well, I want to do baby steps. Let's say, for example, you have $1 million and you say, no, let me go back. Let's say you have about $500,000 and you want to do $50,000, $75,000, $100,000 into the lifetime pension. Yes, you can do that. Then in a couple of years, you like what you are receiving, you are happy with the retirement income option, and you decide you want to up it. Can you increase it? Yes, you can. But I want to just leave you with a checklist of so that people understand, is this meant for me? It's not meant for everyone. This product is not meant for everyone. Now, if you are at a risk of running out of money, so longevity risk, if that is a yes for you, this is something you might want to consider. Now, if your preference is to take monthly payments, monthly withdrawals every month because you have a budget, you have a lifestyle, and you know your budget, and you like taking monthly income from your current retirement income source, then probably you want to consider this too. Then if you want to have flexibility, control, at the same time, you want to have stability and a dependable monthly income, then you're on the checklist to consider this product. Then one of the things we rarely say about this product is that we only share with you the complementary side of it, which is it complements the variable pension benefit. But there's something that Rejoice has said, and I think Nick has also said it today. It can also help you supplement. It has a supplementary feature. And what does it supplement? Your CPP and your OAS, both life income, and tying it with your non-discretionary expenses. The average payment for CPP, I took a look this morning before this presentation for 2025, is about $800. Not everyone gets the maximum amount, $800. And the average OAS payment is about $727, totaling about $1,500. If I have $1,500 and I know what my non-discretionary expenses are, let's say, for example, $2,500 is what I need to meet my expenses, my bills, everything that keeps me alive, then this might be an opportunity to say, well, I have $1,500, which is a life income. Can I get an additional income from the lifetime pension to supplement my life income so that I know all through the rest of my life, I have a dependable income that helps me meet my non-discretionary items. So if you fall into that category, this might be something you want to consider. And finally, if you don't mind fluctuations, your payment is $600 this year. Next year is $620. The following year is $590. In 10 years, it goes up, goes down. But she did show you that trajectory that shows the payment actually keeps going up. then you might want to consider this as an option. And we are here to discuss we are here to discuss with you. My team and I are available to have that discussion with you at any time.
Okay, question on if I choose a portion of my variable pension to go into lifetime pension, can I add more later? This is from Lydia.
Yes, you can add more later. In that case, you will have like a multiple payment. Let's say if I do have 100,000 or 200,000, at this moment, I only want to put 50,000 first, and later, if I like this payment system, next year I'm gonna add more 50,000. Then I will have a two different payment every month. But yes, you can add as many you want, but it should be 1 million or less than 1 million total.
Thank you. I had a few people ask this question. If my beneficiary dies before I do, can I change the beneficiary on my plan?
It now depends on the guaranteed period.
They're saying in the guaranteed period, right?
Yes, yeah, within the guaranteed period, yes.
They can change their beneficiary to a new beneficiary name?
If within the guarantee period, if the member dies within the guarantee period, whatever is left in that guarantee period will go to the estate.
Right.
Yeah.
But if I'm still alive and my beneficiary I've stated today dies and I have I want to place a new name on there. That's what they're asking.
Yes, that's what I'm saying, that if it's within the guarantee period, so if it's a single annuitant and
Right.
You have, let's say, someone's child as the beneficiary and the child dies, the payment will go to your estate if the member dies. It goes to your estate.
I can add this one, Kingsley. Yes. So anytime if beneficiaries dies, you can update the beneficiary. But if member is asking about a survivor, spouse dies, you cannot add anybody as a survivor, but beneficiary, you can update it at any time. Like if I'm nominating right now my niece as a beneficiary, but down the line of 5 years, within a guarantee period, if I want to change to somebody else, yes, I can update my beneficiary.
Thank you. Sherry asked the question, do I need to be retired to take advantage of this product?
So there are two requirements to enroll in this product. As we mentioned on the slide, the first one is the age requirement. You should be the age of 50 and 95, okay? Younger than 95, so 50 to 94. And the second requirement, you should be not working with a PEPP employer, okay? So if you're not working with any PEPP employer, and if you're between 50 to 94, you can enroll into this product at any time. But if you're working somewhere else, apart from PEPP employer, you can still opt for this product.
Yeah, thank you. The second here. Lost my place, sorry. Is there a maximum guaranteed period? A few people have asked that question.
The maximum guarantee period is 15 years.
Okay. And the question from Monique is the consultant information posted on the on your website. So if they do a search, they can find it.
Yes, they can find it under the contact on our website.
Great. And we've said this before, the presentation will be posted on our SRA website. Charlene was asking that question. And okay, I'll wait a minute, see if there's any other questions to come in. I have one that we have in here. If you invest some of the funds in the pension plan, right, what are the risks associated with a lifetime pension? What's the greatest risk to me?
Again, the greatest risk to you is the investment performance. So it's tied or linked to the moderate fund. And as long as the moderate fund is performing above the 4% hurdle, you are fine. If it does below the 4% hurdle, you get an adjustment. And so that's basically the risk involved in that. And it has a bit of longevity risk, mortality rate, but it's risk, but it's a bit not significant as much as the investment risk.
Okay, thank you.
Yeah.
Cindy asked the question, is this transcript of this presentation anywhere? And again, it'll be on our SA website totally. The whole information session will be on our SRA website. Okay. Oh, one more. Neil asked the question, if your spouse dies within the guaranteed period, can you name another beneficiary?
As I said, if your spouse already died within a guarantee period, and if something happened to you, then money will be going to your beneficiary. But you cannot update somebody else apart from your spouse. Like spouse will remain fixed. Beneficiary, you can keep changing. Like if you want to change somebody to else, you can. And if something happened to you and your spouse within a guarantee period, still your beneficiary will keep receiving a payment till the guarantee period is over.
At this point, I have no other questions coming in, Harold. So.
All right. Well, thanks, Lal, and thanks and thanks Rejoice for that excellent presentation, and thanks for those great responses. For both Nick and Kinsley, I think this demonstrates a tremendous amount of interest in this particular program, and we were really very happy to be able to have this presented today. I want to take the opportunity to thank everyone who attended this morning's webcast, and hopefully the information shared has answered some of your questions and with this new pension opportunity. And I think again they certainly provided a lot of information and where you can go to get more information if you need it. And we're very glad to see the member participation at this webcast from across Saskatchewan and beyond. And I also want to remind everybody of our, to keep the date, it's our AGM, which is on May 22nd this year in Regina at the Atlas Hotel. So put that in your calendars and be sure to come to our AGM. It'll be both done virtually and in person this year. And please stay logged in and complete the short survey at the end of the today's webcast. And we want to kind of gather your feedback and your thoughts on the webcast and learn from you, some additional topics and ideas that you may have for future webcasts. And I want to give a special thanks to the SRA board for their support, and John Mulberry plus Lal Fluter in supporting us with the webcast this morning. And a very special thanks to Terry Scott with VoiceWorks and your support team for putting the webcast on this morning. So again, thanks everyone for those great questions. Thanks for the presentation. We look forward to your thoughts and comments, and see you at the AGM, and goodbye for now. Thanks so much.